The history of money. Every single fact you need to know about the history of money. So let's start at the beginning. The first coins were named Lydian lions and were minted or made in nowadays Western Turkey from 610 to 560 BC. These coins were made out of electrum, a natural alloy of gold and silver. On one side, these coins had the face of a lion, and on the other, some kind of deepening. These coins are very primitive, and there is really not that much to talk about at this point. The first big users of standardized coins were the Romans. Starting in the late 4th century BC, Romans continued using coins until the 3rd century AD, the time when Rome fell. Roman coins were made out of gold, silver, bronze, orichalcum, and copper. On one side, the coins had the face of the leader, the year when the coin was made in, the name of the leader, and on the other side, they usually had Jupiter holding a thunderbolt. Romans were also the first people to start putting border dots on their coins. In the early Middle Ages, Charlemagne, the emperor of the Holy Roman Empire, established the first standardized coin in Europe after the Roman Empire. The coin was named Weisfang or white penny and was made out of silver. On one side, the coin had a cross, border dots, an emperor's face, a letter that indicated the place where the coin was made, and on the other side, it had border dots, the temple, and what I think was the name of the temple. The biggest change that period brought to coinage in Europe is that now, instead of many different coins, there was only one. So you might ask, but the money that I use is mostly paper. But you're only talking about coins. Where's paper money? Well, paper was not invented until 105 AD in China, and it didn't reach Europe until the 11th century AD. Most of you have figured this out by now, but the first paper money was invented in modern day China. This money was called Jozi, invented in 1136, and was worth anywhere from 500 yuan, some Chinese currency, to 5 yuan, some other Chinese currency. Even though there were some kinds of paper money before, most historians agree that Jozi were the first real paper money. By the 13th century, paper money was already known in Europe, thanks to explorers like Marco Polo or William of Robert. By this time, paper had already reached places such as Italy and Spain. In Italy, merchants started using promissory notes. You might ask, but what are promissory notes? And I get you. So, a promissory note is an unconditional promise in writing made by one person to another, signed by the maker, engaging to pay on demand or at a fixed or undeterminable future time a sum in certain money to or to the order of a specified person or the bearer. Don't get it? Pretty reasonable. In human language, a promissory note is a written unconditional promise signed by one person, the maker, to pay a specific sum of money on demand or at a fixed future time to a specified person or bearer, serving as a legally enforceable document in financial transactions. Mid-episode drinking reminder. Please have some water right now, or you will suffer later. Then, let's continue our journey. During the European trade expansion in the late Middle Ages, Trade bills of exchange gained significant popularity. This was particularly evident with the flourishing Italian trade, which included wine, woolen products, tin, and cloth. As trade volumes increased, the demand for trade bills of exchange grew, as they provided a convenient and reliable method for facilitating commercial transactions. You might ask, "But what are trade bills of exchange?" And well, a bill of exchange is a written order used in international trade to bind one party to pay a fixed amount of cash to another party on a predetermined date or on demand, serving as contractual agreement that facilitates transactions by reducing risks and ensuring secure payment. During the period spanning from 7th to 12th century AD, a dynamic monetary economy emerged, driven by increased circulation of stable and valuable currency in the Islamic world, particularly the dinar. The expansion of economic activity was accompanied by significant innovations attributed to Muslim economists, merchants, and traders. These pioneering individuals introduced a range of financial practices that revolutionized commerce, including but not limited to the concepts of credit, checks, loans, and debt. Through their ingenuity and foresight, they laid the groundwork for development of sophisticated financial systems that continue to shape the modern global economy. Goldsmiths in England have been craftsmen, bullion merchants, money changers, and moneylenders since the 16th century. In the 17th century, scriveners were the first to keep deposits for the purpose of relending them. Goldsmiths, known for their craftsmanship, gained trust and became reliable figures in finance. They offered secure storage, loans, and currency exchange services, playing a crucial role in financial stability. Their adaptability and contributions laid the foundation for modern banking practices, shaping the financial industry to this day. The first banknotes in Europe were issued by Stockholm's Banco, a predecessor to Sweden's central bank, in 1661. These banknotes were introduced to replace the cumbersome copper plates that were previously used as means of payment. The banknotes greatly gained popularity due to their convenience and ease of use. However, in 1664, the bank faced financial difficulties and ran out of coins to redeem the notes, leading to its closure in the same year. Despite the challenges faced by Stockholm's Banco, the introduction of banknotes marked a significant milestone in European banking history and paved the way for development of modern style banknotes and the establishment of central banks. The development of computer technology in the second part of the 20th century revolutionized the way money was represented and transferred. With the advance, advance of digital systems, money could now exist as electronic data. This technological advancement paved the way for the digitization of financial transactions and the rise of the electronic banking. By 1990, in the United States, the majority of money transferred between the central bank and commercial banks were conducted in electronic form, eliminating the need for physical currency in these transactions. This shift towards digital money opens up a new possibilities for faster, more efficient, and secure financial transactions.